The best strategy for our clients that we've recommended is you just want to be a long-term holder. But most people don't approach crypto that way. Most are trading it and want instant return. The work by our technical strategist, Mark Newton, so he thinks Solana, Ethereum, and Bitcoin all have downside. He has been bearish since mid-January. So I think it's been correct. And his downside target for Bitcoin is 62,000 by the end of March. But to me, is 62,000 a reason to turn bearish on Bitcoin? I mean, if you're trading it, yeah, but Bitcoin was $1,000, well, $100 10 years ago. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving. I don't think it moves. It's still a risk on assets. So I don't expect it to do well if the market is being hit by tariffs. Like it's not immune to that kind of turbulence. But
Tom Lee remains bullish on stocks and Bitcoin, despite short-term market volatility. According to Lee, the recent pullbacks are temporary corrections, not trend reversals. He believes strong earnings growth, liquidity conditions, and improving macroeconomic factors will drive markets higher in the long run. While some analysts warn of potential downturns, Tom Lee points to historical data showing that bull markets often climb a wall of worry. He remains confident that Bitcoin's long-term trajectory remains upward, fueled by increasing institutional adoption and its role as digital gold. Please remember to like this video, subscribe to our channel, and enable post notifications if you have a strong interest in learning about the future of finance and the function of digital assets like Bitcoin. This will ensure that you never miss anything. Thank you, and enjoy the video.
The CPI, PPI, PCI, all the components of inflation that clearly populace is upset about for good reasons because they're paying more for things. Should the market be equally upset?
Well, inflation is a problem because prices aren't going to go back down. And they're up 50% over the last couple of years. And so I think it's going to be harder and harder for consumers to tolerate more inflation. Even if it's still at 3%, it's still going to be unbearable. But if I look at it from a markets lens, I know a lot of people are saying that there's a second wave of inflation underway, or it's picking up and you're seeing it in the consumer surveys. But I think we don't know what the seasonality is. And I think the consumer surveys themselves are actually very flawed right now, and they're picking up less the fact that egg prices are up, and I think more political respondents. Like the UMich survey, there's a huge bifurcation between Democratic views on inflation versus Republican. And the bond market itself is giving very conflicting messages about inflation. In fact, I would say if I looked at what the bond market's saying, I think it's saying there's no problem with inflation. The reality is that if policies are enacted that create such a severe shock because of tariffs, then we could have a recession, right? I mean, that's like a fact. Because if you put a 300% tariff or something, we don't really know how to titrate that number. And that's why investors are nervous. But it's at the same time, the tariffs are accomplishing the administration's goals. Because if I was the White House and I know that I have some opposing risk from the Fed today, because the Fed's hawkishly paused. Well, if the tariffs are causing confidence to fall and business activity is slow, then the Fed has to get off neutral. And but then everyone's playing a dangerous game because, as you know, you don't want to get stall speed in the economy, because the day the economy gets to stall speed, we open up the uncertainty of a recession, because a shallow recession. A recession is unknown once it starts. The market is trying to price in a lot of these uncertainties right now. And so it's understandable that we're churning, but investors don't want to become too bearish, because the market sentiment, and it's already measurable, like the AAII survey, which is what we've used for the last 14 years. I think it's the best retail sentiment survey, is at the same bearish levels it was in the fall of 2022. So retail sentiment, and that's probably because there's been a ton of margin calls last couple weeks, is at the levels that were at the depths of that recent bear market. So the investors view this as a crisis when it's really a growth scare. So to me, I think there's a good chance we're making our lows for the first half, like this week. And
like down 5-6%, you mean?
Yeah, it could be.
Yeah.
The only thing is I'm not that optimistic about the job picture for the near term, so maybe that's one last leg. But the reality is that a lot of bad news has gotten priced in. And, on the flip side of this is that the closer we get to stall speed, the more the Fed has to get off neutral. And I think the White House will have to back off talk of things that could be hurting the economy. The best strategy for our clients that we've recommended is you just want to be a long-term holder. But most people don't approach crypto that way. Most are trading it and want instant return. The work by our technical strategist, Mark Newton, so he thinks Solana, Ethereum, and Bitcoin all have downside. He has been bearish since mid-January. So I think it's been correct. And his downside target for Bitcoin is 62,000 by the end of March. But to me, is 62,000 a reason to turn bearish on Bitcoin? I mean, if you're trading it, yeah, but Bitcoin was $1,000, $100 10 years ago. So, 60,000 is still a fantastic return. And I think Bitcoin's usefulness is still improving. I don't think it moves. It's still a risk on assets. So I don't expect it to do well if the market is being hit by tariffs. Like, it's not immune to that kind of turbulence. But is the trust around Bitcoin going to grow over the next 5 years? Yes. And is it going to be increasingly viewed as a store of value like gold? Yes, I think increasingly. And then is there room for a lot more people to own it? Yes. So I'm not really bearish on it, but I think in the near term, it's hard to say it should go up right now.
Financial equities are hidden winners in today's market, according to Tom Lee. Banks and other financial organizations have suffered for the last 15 years due to strict rules and difficult economic conditions. But Lee thinks that's going to change soon. Despite an inverted yield curve and the Federal Reserve's strict rules, big banks like JP Morgan have proven resilient and lucrative. Financial stocks may increase in value when the economy improves. Tom Lee believes small cap stocks have a lot of potential as well, particularly as trade and tariff uncertainty subside. Please take a moment to like this video, subscribe to the channel, and enable post notifications for future Bitcoin, macroeconomic, and digital asset content before we go any further. Now, let's get into his powerful predictions.
To me, one of the, I think, sleeper winners from all of this is going to be the financials, because they've underperformed the last 15 years. So they really have not caught a break since the GFC. And finally, an environment that is better for the banks, and AI is actually good for business. And JP Morgan and all these banks show they made money through inverted curves, hyperinflation, tightest Fed ever. And now you have all this reversing. Another group that I think makes sense is digital assets. I do think, so Bitcoin is down, but it's our clients, it's actually not a surprise to our clients, because Mark Newton, our head of technical strategy, really pointed out the cycles in mid-January that he was targeting 62,000 for Bitcoin by the end of March. So we're actually on our way to 62, but that's not a bearish development. It's just a retracement. And the third, of course, is small caps, because once the tariff talks go away, the environment is favorable for American-focused companies, which would be, small companies, and they'll benefit from lower rates and their multiples are lower. So I think it's still a big opportunity. But in the middle of tariff talks, none of these groups can really do that well.
Too much panic. I think that move in December after the Fed meeting, that felt really bad. But we were not making, it didn't take long to make new highs.
Well, I think that July to August was essentially, I would say, Fed driven.
Yeah.
And so that makes sense, because it felt like either the Fed made a policy error or the Fed turned hawkish. Right. But either way, we had a big drawdown. Will that happen this year? I mean, yeah, I think it'll happen. If I'm guessing, it's more in the second half. So I think this is just a flesh wound right now, not the source of a drawdown. Okay. I think that there's a lot of logic to what if Besson's focuses on yield, because we know that you live off what's priced off the yield. So mortgage rates would fall, cost of borrowing would fall. That helps a lot of Americans, but it doesn't mean they want stocks to fall. Right. So I think that people are making that logic leap. I think that the administration doesn't want stocks to go up if there's tough tariff talks, but it doesn't mean that they want the stock market to be down 10% this year, because we know all recession probability models, just exactly what you said, Guy, they go up, because the largest predictor of recession is the stock market. So if it's down 20%, then all of a sudden austerity has to go out the window. You have to do entitlements, and the Fed has to unleash liquidity. And that's the exact opposite of what they're trying to accomplish. So I don't think they really want a down market. They don't want the market to not respect their message right now. One of the reasons we weren't that cautious or expecting a recession is that a recession is often two conditions, not just one. Most people thought, hey, the Fed tightens, and Feds are responsible for all recessions because, they say expansions are murdered by the Fed. But really, that happens when the economy has exhausted incremental return on capital. And if we go back to the 2021, 2022 period, private investment spending as a percentage of GDP was still near recession levels. So capital spending wasn't exhaustive, and consumers' debt service ratios were still at recession lows. So it was hard for us to argue that the Fed and its tightening, even though it inverted the curve, would be enough of a contractionary pulse to actually push us into a recession.
According to Tom Lee, the Federal Reserve's policy stance was a major factor in the market decline that occurred in July and August. He explains that a severe market drop resulted from investors' fears of either a policy error or a more aggressive turn from the Fed. Although he views the present pullback as a moderate one rather than a catastrophic crisis, he anticipates another market downturn in the near future, most likely in the second half of the year. Lee also explains the reasoning behind concentrating on yields as opposed to stock prices. Without necessarily causing equities to decline, falling bond yields benefit American households by lowering mortgage rates and borrowing expenses. Lee contends that although the government may not want a sharp increase in stock prices during tariff talks, they also do not want a significant market meltdown because a sharp drop of at least 20% would raise the risk of a recession and force policymakers to reintroduce liquidity into the system and abandon austerity measures. He does, however, accept that there are increasing concerns in the labor market, citing possible shortages in the workforce brought on by government austerity measures and immigration laws. According to him, the growing number of jobless claims and real estate listings in Washington are early indicators of economic hardship, raising investor concerns that the labor market may perform worse than anticipated in the first half of the year. Lee also emphasizes how crucial asset values are to maintaining economic stability. A stock market or housing disaster is more likely to cause a recession than a decline in bond or auto prices. According to him, regulators are conscious of this dynamic and would work to keep the market from plunging further. Remember to like this video, subscribe to the channel, and enable notifications if you thought his viewpoint was helpful so you don't miss any updates. We'd love to know what you think about the future of cryptocurrency markets, so please share your ideas in the comments section. We appreciate your time and hope to see you in the next video.